Welcome to The Educated Trader. I'm Dr. Alex Mosley and I'm going to take you through the very basics of trading principles. This lesson, the fourth in the series, reviews our first price indicator, namely support and resistance levels. Now, if you're a beginner trader or just curious and you've come to this video and you've not checked out the introductory videos, I suggest reviewing those first, as the more we get into these trading principles, the more I will expect a basic knowledge, notably in reading price charts. In this section, we're going to look at how we can identify our first indicator, a price indicator, in which previous prices encountered on the market may act to provide a support or a resistance. This in turn may help guide us to form a strategy or provide some assistance in knowing how a market may react around certain prices. In the previous tutorial, we reviewed a trading range. I've repeated the slide here to give us a simple understanding of support and resistance levels. The high on the left produces the resistance which is not broken as the market falls and later fails to breach. The low, identified at the left-hand side of the diagram, becomes the support, which also is not broken as the market proceeds into what is called a consolidation, a ranging market or a sideways market, or, my favourite, a penguin market, huddled around a certain price territory. Now, supports and resistances can also be called floors and ceilings, and often we use the word resistance or support interchangeably. If I am long and I hit a ceiling, we can say that other traders are acting to resist any further upward movement, and if I'm short, that same resistance now becomes a support. Either way, the concept is that a price may be acting as a magnet, attracting in potentially contrary traders who push back against the prevailing move, as well as trend traders looking for the price to break through a previous support or resistance. They are, I'll repeat often in this, interesting areas to get to know. Now, the above idealized example may occur on any time frame: the daily, the 4-hour, the hour, the 5-minute or the minute. The existence of identified supports and resistance may help us to form that strategy, or provide us at least with tactics as to what to expect when entering the area of a previous floor or ceiling. But we can also have much activity between the highs and the lows, and we may be able to create strategies to trade between the supports and resistances. Let's have a quick look at what I mean by trading within support and resistance levels. Here, a high and low are identified at the beginning, and we then experience a bear trend coming off the high, which may indeed be tradable. There is a failed bull contrary move, followed by the resumption of the bear trend, and finally there is a narrower identifiable range on the floor. What we can sometimes find is that previous floors and ceilings act as what I call these live wires, horizontally extended lines that create areas of volatility. They are always areas of interest to take note, for they may provide setups for new orders or places to end a trade, a target for a trade as it were, or just areas of expected turbulence that we may have to sit through. Let's have a look at some historical examples. Here's an example from the DAX, the German Equity Index. The market has bounced off a low and encountered resistance at A, which occurs perhaps unexpectedly around an old pullback that might not have otherwise attracted our attention. Nonetheless, this resistance at 11,750 acts like a live wire, rebutting attempts to break through at B and perhaps at C. We'll check what happens next. The bulls eventually break through our initial resistance and push up to a new high of D. Now let's see what follows on from this. We have two tripwires, as it were, and we want to check how the market, the bears and the bulls, how they react to these areas of local resistance. Firstly, the market drops back to the prior resistance, for which a moment at E acts as a support, but then it pushes back up to the new ceiling and encounters resistance at F, falling back and then breaking through E's price support. As the rest of the month proceeds, we can identify periods of volatility at and between those two upper live tripwires, and a strong reaction on the lower boundary. The lower of the two upper boundaries produce the most obvious reactions, with 2 attempts at breaching the upper price resistance before it breaks out on the second try. Using the same chart, we can also identify other areas of localized volatility. Firstly, check out what looks like a market skidding to a halt and then retrying the bear run down to the live wire. Note that this takes place around a big number, 11,500, which we sometimes get experience of as also acting as an area of psychological support. Traders may have orders to take out live trades or to enter around these numbers based on past experience. Let's put that line on the graph to see how live it is. Yes, it does seem to attract volatile conditions in the period we're looking at and acts as a support and resistance area. The second area of interest is around 11,700, 50 pips below or points below the original ceiling. Does this number have an effect? Well, putting on the second dotted line shows it too acting like a well-disguised live wire crossing our path. There is volatility under it and volatility above it, so it too is acting as a floor and a ceiling. There is another area of support around 11,600. This, we can see, acts as a floor 4 times during the period. Now we have created several supports and resistance lines. Traders do seem to get into skirmishes around them, though sometimes traders push through them as if they did not exist. They skip over the tripwires, as it were, as we see in these 3 examples. What can we take from this? That around previous levels of support or resistance, we may generally expect some kind of reaction, but not always. Nothing is to be taken for granted in the markets, though it is interesting to see how traders, or their programs, which are a reflection of the traders' beliefs anyway, come into play on both sides of the long and short trades. Some will be taking profits from their positions or cutting their losses. Some will want to join in the market on reversals or breakouts around these levels. Whatever strategy we personally create in our desire to trade profitably, it's worth bearing in mind what may happen around these live wires. Sometimes, if I'm expecting such turbulence, I create a swampy looking brown box to remind me to expect sticky prices. What I sometimes like to do with these broader areas, these swamps or no man's land areas, is to highlight the breadth of them. The above example, which happens just before the other periods we've reviewed, presents firstly 2 hits on what becomes our ceiling. The ceiling is then breached, but note at the 3rd circle, the ceiling now acts as a floor, as it were. This gives me an indication that the market may be reacting around this price going forward, which we can see it does, breaking through the floor, but then testing the ceiling 5 times before wandering off towards the end of the screenshot. Note also that this swampy area occurs around the 12,400. My box is actually drawn approximately 12,400 to 12,490, creating a mean of 12,445. Whenever the market enters this area, there seems to be turbulence, like a bad weather system, which can reflect the competing expectations in traders' minds about what the market will do around this area, as evidenced by the price action on the chart. Now, following this period, you can see the brown swampy period to the left. Entertainingly, the market returns to the swamp, which I've now coloured pink to distinguish it from that previous section. The market moves from below the swampy area, and at first the bears put up no resistance, as a strong bull move takes us to 12,600. But this price turns out to be a strong resistance in its own right, which we can identify by the 2 hits on the exact price, before the market is then sliced again, this time by a strong bear move. But then our support line comes alive again and resists the bull's pressure to break those highs. Here is the same live wire over a month later. It becomes active in September 2019 with renewed attempts by the bulls to break through the area. The attempts are all repulsed. A few weeks later, and the area is finally broken through, as seen on this slide. On October the 13th, this is. But you can see how the area still creates sticky prices on and around the same live wire in this swamp. So let's finish on reminding ourselves what we're looking at here. Price supports and resistances, or floors and ceilings. These are specific prices or areas around those prices that market traders tend to react at for whatever reason, if only for the belief that they believe that other traders believe those areas are important. That may allow us to adjust our own expectations regarding these historical areas of swamps and live wires. But recall, there is nothing certain in trading. There are patterns, and those patterns, however, are in forever flux. What was a live wire last week may be completely ignored this week. We can only tell after the event. Here's a broad overview of the euro-dollar on the daily chart from the start of 2017 to November 2021. I've sketched onto the screenshot some key turning points. Pink circles for the reversals from bear to bull markets, and blue circles for the bull to bear reversals. Let's look further back in time to see if these lines were live before 2017. Now this shows the period of October 2014 to January 2017. The last circle on the bottom right being the first circle on the previous screenshot, so we've gone back in time. The market enters a broad trading range between 11,600 and 10,600, and we can see that it hits our floor 4 times and that the ceiling is hit twice during this period, after having come down in a strong bear move during 2014. Prior to that period, the market was trading much higher. Now this exercise may have its uses. Where we identify current supports and resistances, we may find that historically these have been important price areas in the past. The problem, though, is that we can identify many such areas, and perhaps we do not want to cloud our screens with a cat's cradle of too many lines going back into the depths of market history, noting them when they do turn up, but perhaps not plastering our screen with them, as in this shot. This is the euro dollar going back to the early 1980s, when it was traded as the euro dollar rather than the euro currency and the US dollar pair. Key supports and resistance can be identified as they may have a use, but let's zoom in to the most recent screenshot of the same market. Here are those same lines, but now zoomed into over the last 2 years. We can see that those historical live wires can still have their effects as noted in the circles. But there are also areas of support and resistance that do not relate to historical prices. These may be more local to recent price moves. They may not have happened in the past, but they may now be active moving forward into March 2022. What we sometimes hear in trading is that where there is a lack of local support or resistance, that the market may freely move towards a historical level. For instance, if we look at the price rise with the arrow, we may have held an expectation that the price would continue upwards to around A, a previous resistance area. Instead, it gets stuck around B, and then C. Now these may be recent swampy areas, of course, created by local conditions, but even if they were not, it's worth reminding ourselves that what has happened in the past is certain no indicator of what will happen today, even though they do often create an interesting area to review. To summarise, here is the idealistic version that I showed earlier of how a range may form between the floor and the ceiling, and how traders may react to certain price levels and cause what we can call price stickiness as we can see in the next slide. Here I've added a slightly bit more detail to show how a price may respect a floor, then break through it, return to touch what is now a ceiling, break through that, test the floor again, etc., etc. It is quite astonishing how often floors and ceilings may still act on prices over a period of time. The market traders carry a memory, as it were, of what has been, and their actions around such prices can generate self-fulfilling prophecies to an extent. But there are times that historical battle areas between the bears and the bulls are completely ignored. There is no certainty in trading. Now, I hope you found this section somewhat useful. The next section reviews trend channels and how to identify them to see if they may be of use to our trading. I'm Dr. Alex Mosley.